Welcome. We are going to learn about corporate financial policy and corporate financial analysis in this course. And in my mind, this is one of the most interesting business courses you can ever do for a simple reason. This is a course which has a lot of math in it, but it's not about math at all. It's going to be about incentives. It's going to be about information. It's going to be about human behavior. So when you look around and when you look at different course offerings, in this course, you'll see a perfect intersection of how numbers interact with human behavior. In fact, much of finance is all about that you start with numbers, but the real issue there is how human behavior shapes incentives and information and shapes, therefore, policies of firms, policies of investors, around the global financial markets. And in this course, we're going to focus on financial policies from a corporation's perspective. So we'll break it down, our learning, into 2 or 3 simple pieces. What I'll do, I'll start with a few examples from the real world. And in the first 5 or 10 minutes, I'll just leave you with questions. Leave you with questions that corporate managers around the globe face on a routine basis. And then we'll start with a framework that, faced with those questions, how should we approach them? And then finally, we'll do a lot of analysis that with those frameworks, we want to address those questions. So there will be a lot of these analytical toolkits that we'll learn throughout this course. All right? So there would be real world examples, framework, and analysis, and that would be the kind of broad linkage that you'll see across the board in this class. All right, so let's start with an example from a company that we all know of, Apple. And let me start with Apple's balance sheet as of September 2015. Okay, when I say Apple's balance sheet, often, unless I qualify it, you think of Apple's book value balance sheet. So what do I mean by book value balance sheet? This is simply you look at their annual statement, and what you have in front of you from the year end of September 2015, Apple had, and I'm presenting a very simplified version of the balance sheet, where if you look at on the asset side, I put cash and non-cash asset. Everything that is not cash, I just club it together, I call it non-cash asset. Some of you might have heard that Apple has a lot of cash on its balance sheet. Yeah? And that's why I'm presenting it between cash and non-cash asset. In book value terms, Apple is a $290 billion company, as you can see right there on your slide. Now, when you come to the liability side, one way you want to think about the liability side is, so how is this $290 of asset being funded for Apple? And again, I'm breaking down liabilities into 2 pieces. The first one, the top one, is all about debt. And there you have current liability. Think of this as supplier's credit and think of this as short-term liabilities. And then you have debt, borrowings from banks, bond market, and so on, of $101.12 billion for Apple. And below that, I have equity, the shareholders' money in the company. And in book value terms, this is $119 billion. And of course, sum of all my liabilities and equity should add up to exactly the same amount as what I have on the asset side. You know this. By the time you're doing this course, you have seen this kind of balance sheet again and again and again. So I'm not going to dwell too much upon the details of balance sheet, but the question that I'll ask you is this. Could you have bought Apple? Imagine that you are a corporate raider. You want to just acquire Apple as a whole. Could you have bought Apple based on its book value of $290 billion? What do you think? Most of you are thinking, no, to buy Apple as a company, I'll have to pay the market price of equity, isn't it? If you go in the market and say, look, I want to acquire Apple as a whole, you'll say, so what is the stock price, the market price, not the book value of Apple? And here on your slide, I'm putting the stock price on the same day, the day on which I drew this balance sheet in book value term. Then you also want, so how many shares are outstanding or were outstanding of this company on that day? And that was 5.58 billion shares. Then When I multiply the number of shares with equity price, then I have the market cap of equity for Apple, which is $612 billion approximately. So clearly, to just acquire the equity of this company, you needed way more than the book value of this company, $612 billion, right? Now, Apple is worth way more than its book value, right? That is obviously very clear from our discussion and the numbers on the balance sheet. So, let me introduce to you a notion of a different kind of balance sheet, which I'm going to call the market value balance sheet, where the idea is that if I have to acquire a company, or if I think about how much is this company worth, then this balance sheet, the market value balance sheet, is going to be more useful, because that's the balance sheet that we'll be trading, not the book value balance sheet. All right? So let's see how I'm drawing this market value balance sheet. The first thing is the debt's market value, I'm taking it as equal to its book value. And this is a reasonable assumption for a company like Apple. For a healthy company, the market value and book value of debt is likely to be very close. Company is very far away from default, so if it has $100 of debt, then in the market, that debt will trade for $100. That's the assumption I'm making. Reasonable assumption for a company like Apple. And we just saw the market value of equity. Now let's go on the asset side. The market value of cash, again, a reasonable assumption is that equals book value of cash. $205 billion of cash in Apple's book value balance sheet is $205 billion of cash in market value terms, right? So now to add up this balance sheet, what's going on? So on the liability side, we got all the items. Debt equals market value of debt equals book value. We just computed market value of equity of $612.86 billion. So I have the total market value on the liability side. And then on the asset side, I have the market value of cash. So only thing that is left now, I'm calling that the non-cash asset. And the difference between the entire value of the firm here, and 205, this difference I'm plugging in here, and I'm calling that market value of non-cash asset. For this company, for Apple, what is this? This $578 billion tells you that the enterprise of producing iPhones and iPads and the Mac computers, market is putting a value of $578 billion on that enterprise. In addition, Apple has $205 billion of cash. So together, market is putting a total value of about $783.9 billion for Apple. Fair? So this non-cash asset is essentially market's valuation of how much asset Apple has right now. But this is, since it's market price goes up not only for asset that you have, but also the expectation of your growth in future. And that's why the market value of non-cash asset is a sum of both assets in place and growth options, as I call them. Potential to grow its iPad sales, potential to create new product in future, market is paying a price for that based on market's information as of today. Fair? So the market value of non-cash asset can be summarized as present value of expected future cash flow for Apple based on market's current information. All right. So now I'll talk about something interesting based on now you have understood book value versus market value. And let me now talk about some interesting thing that has been happening for the last 3-4 years in the stock markets about Apple. Some activist investors, and who are activist investors? Investors who take a position in a company's stock, and then they try to influence the policy of the company, right? Either by their direct intervention in the management or by encouraging management to do certain things. So there has been some interesting back and forth between Einhorn, an activist shareholder, and Apple. And here I'm reading something from just a part of this Einhorn's letter to Apple shareholder way back in 2013. So the Apple's balance sheet that you saw was, for convenience, I drew it from 2015, but Apple's cash buildup has been going up for the last 3, 4, 5 years. So way back in 2013, Einhorn wanted Apple to pay out its cash. So you can compute the per share dollar value of cash that Apple has. And Einhorn wanted company to pay out that cash as dividend. And his idea was that, look, as a shareholder, so this is the letter he's writing to the shareholder of Apple. And he's claiming that, look, Apple has a lot of cash, and as a shareholder, this is your money. All right? So Apple should pay out, the board of Apple should pay out this cash as dividend or some other scheme of paying out to its shareholders. Fair? So the idea in corporate finance is that, well, if Apple pays out, first we're going to focus on, to answer this question, we're going to focus on the market value of the balance sheet. And the idea is that if this cash gets paid out to shareholders, then are shareholders better off? Or are they likely to be indifferent between cash sitting in the company and cash sitting in their own pocket? One way to rephrase this question is that, look, if after all this cash that is sitting in the company's balance sheet is my cash as a shareholder, then do I really care if cash stays in the company or cash comes in my pocket? As I said, I'm not going to give answer to this question right now. But these are the kind of questions we care about in corporate finance. What should be a company's optimal cash balance policy? And in this case, a symmetric question arises. What should be a company's dividend payout policy? These are the things we want to learn. So now, let's see what happens if cash is paid out as dividend, as Einhorn has been demanding. And now, and you'll see that often in corporate finance, that we'll focus on the market value balance sheet. Because that's what at the end of the day we care about. So how? Let's see right here. So this is the market value of balance sheet that Apple has that we talked about, right? With $205 of cash. Imagine Apple as a company pays this cash out completely. So now I'm going to draw, together we can do it, market value balance sheet of the same company after this entire $205 is paid out as dividend. Then what would happen now? The cash balance now goes down to zero, right? This has been paid out. But as long as nothing changes in the iPad, iPhone, and the Mac computer enterprise, then this value remains the same. If nothing changes, whether Apple pays cash as dividend or not, if the enterprise value based on iPhone, iPad, and so on remains the same, then this 578.98 is exactly 578.98 here, giving me with a total market value after the payout of 578.98, right? Let's see what happens on the liability side. Now, immediately you'll see that when I pay out cash as dividend, the debt holders, they are not suddenly going to say that now instead of $101, you give me anything less. Their claim or how much you as a company owe to your debt holders will remain the same, right? So that's why these numbers are exactly the same here. So the adjustment, where will the balance sheet add up and match? The adjustment will happen here in equity. Shareholders got their cash. This 205 went in their pocket. So the money that they had in the company came down from $612.86 to this number, which is exactly lower by the amount of cash, right? And there's a big assumption I'm making here. That is, share price drops exactly by the amount of dividend, right? That's why what is happening is that you have the same number of shares, and now share price drops by the amount of dividend. So the value of equity drops just by the amount of cash that was paid out to shareholders. So the question is then, are shareholders of Apple better off if company pays out cash? In this example, you see that this was simply taking money from one pocket and putting it in another pocket. Shareholders initially had $612 in the company. Now they have $407.86 in the company and $205 in their pocket. So there has to be something more to this story. The way I laid out this story right now, based on the assumption that share price drops exactly by the amount of dividend, shareholders are no better off, no worse off if company kept cash on the balance sheet or paid out. We want to understand under what conditions shareholders may be better off if the cash is paid out, or maybe worse off if cash is paid out. We want to understand these questions in corporate finance. So what I'll do, I'll leave you with these questions, and we'll do one more example from real world before getting into the framework of corporate finance.